Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, June 25, 2015. So we're looking at a daily chart of the SPY, and as you can see, and I know the chart's a little busy because I've got all those lines up there, but nevertheless, I need the lines in there to kind of, it's more of a guide, and it's like my roadmap. So I'll zoom in here on the 60-minute chart, and we'll take a closer look. So what you can see is that we came into the 210.57 and beat around that for a while, and the more you beat on a price level, the more apt it is to break, and that's exactly what happened here today. So after breaking down below the 210.57, we went, as you could see, in the 1 hour candle, this is 1 hour, this big red candle, we went right to the 209.91, pierced through it, bounced up, so it did hold. The last hour of the day came down, and again, like I said last night, it's how you close them, not how they trade them, and they traded them and closed them poorly today, so I expect another day or two of downside pressure, and it didn't look like that was going to happen in the morning. We woke up this morning and the futures were up. Market opened up a little higher today, and it looked like we might trade okay. It looked like it was going to be a light volume, basically like a pause day from yesterday after the big down day, but that didn't happen. We rolled over, and that's indicative of what I thought was going to happen, right? So a little more downside to come, I think. The next area would be a 209.18. And we can just actually call that 209 because there's a high probability if we got there that they would want to go test 209. But that should give us a good guide for tomorrow. And if that doesn't hold, then there's a chance we go down to this double bottom area, and that could also happen by Friday or Monday. So speaking of Friday or Monday, I pulled an interesting statistic today. This year, we've had more down Fridays by a significant margin than we had last year. Last year, there was only a handful of down Fridays in all the 52 weeks. I think there was maybe, and I don't remember the number exactly, but I think it was 10 or less. And this year, it's actually flipped around, and it's 60% of the down Fridays. I have the number here. It was out of, I think there was 23 Fridays, and I think I don't know. I don't remember. I just have 60%. I did the calculation on my paper here. I didn't write down the exact number. So 60% of the Fridays are down this year, and some of them are down pretty significantly. So I'm not suggesting that's anything to hang your hat on for tomorrow. I'm just saying that it's just something to keep in mind, especially since I'm expecting a little more downside pressure on the markets into tomorrow and maybe even Monday. But after that, I expect that the market should resume an uptrend. And one of the things that's interesting is this week on the volume front, we've been coming down on relatively light volume. And what that normally means is that there's really no significant institutional selling pressure in the market. It's selling pressure, yes, but as far as distribution, and what that means is when the large institutions, the mutual funds, the pension funds, the prop trading desks, all the large institutional players that are trading tons and tons of money, millions and millions or hundreds of millions of dollars, billions of dollars, it doesn't look like they've been distributing shares to the public, right? And that's usually what happens on large down days. They're normally just selling indiscriminately, and that's not what's been happening here. However, there is something else to keep an eye on, and I'm just going to do something that I don't normally do, but I want to show you a chart of Apple, and Apple has me a little bit concerned, and I'm going to show you why. Because I can take this out. This isn't really valid right now. So I'm going to put in a trend line on Apple, and here's a bottom trend line. Well, I'm going to bring it up to the closes, or the opens or closes, and then there's another trend line that we can draw from the top here, and then I'm going to talk about it. Okay, so look what we have here. Okay, so what we have is Apple's been trading in a range, but it's weak. So when you made this high here and sold off, the market tried to rally back and take out that high, but it wasn't able to. Okay, and this was what was called, this day is what's called a gap and crap. So we gapped higher, and then we sold off, and then it continued to sell off. Now, you're holding this trend line down here, but really by the skin of your teeth. Up here, there's a lot of resistance here. So really, up until the point in which you can close above this trend line, Apple's going to remain in this range. And if you break this trend line to the bottom, what happens? Well, your first level of support definitely going to be right here, okay? And that's not, I shouldn't say first level, that's going to be a very, very solid level of support. And that puts the market at about 121.5, we'll call it. And if that doesn't hold, then you go down to the 200 moving average. I don't think we'll get down that far in Apple, but nevertheless, there's a lot of support in this area here, as you can see, at 120. So I just want to point that out, because if Apple's going to break lower, the market's going to go with it. It's very rare that Apple is going to go down without the market. The market goes up, Apple goes up, Apple goes up, the market goes up. That's normally the way it works. It is a market leader. So I just wanted to point that out. And I know some folks are long Apple. I'm long Apple. But on a break of this trend line, we're going to have to be careful, and we're going to have to watch. And I'm not going to sell out on a break of this trend line, because I believe that we're going to have one more rally in the market that should start next week. And if that's the case, I expect Apple to rally with it. But just be aware that, for example, tomorrow and or Monday, if Apple does break this trend line, it could be in some trouble. So I thought that was just an important piece of information that some folks would like to know. While we're talking about market proxies, let's talk about the IWM. And what was interesting today with the IWM, and I want to bring up a shorter term time frame. I'm even going to bring up a 10-minute chart on IWM, and you can see that while the S&P 500, the spiders, the E-mini all finished down today about 1/3%, the IWM was basically flat. And what's interesting is you made a low along with the spiders in the IWM, but you rallied up and held that rally. So, as you know, when the small cap index and or the NASDAQ index, which are normally risk assets, when they rally or when they lead the market, whether it's up or down, it's usually an indicator of something to come. So that's more evidence. So I've got the light volume. I have a cycle turn date that should be occurring between, it kind of falls over the weekend, so it's always a plus or minus 1 day thing. And I'm going to suggest that more likely Monday. I don't see a big update tomorrow, although you never know. Anything could happen. Greece could certainly spark a rally in the market by some kind of deal they make with the European Union. That's certainly possible. It would be an excuse for the rally, not the reason. It would spark the rally, but I'm telling you, we should get a rally by Monday or Tuesday anyway. So whether they want to pin it on Greece or they want to pin it on something else, that's up to them. I'm just telling you that it's likely that we'll see a little bit more downside in the market, but I'm not looking for a lot, and I'm not anticipating, I'm going to go back to the SPY for a second. I'm not anticipating the double bottom getting hit, but that doesn't mean it can't. It's just something that I think, even if it does get hit, I think it will hold. And I'm just not able to find any calculations that I'm doing that tells me that that's not going to hold. But that doesn't mean it won't. It's just I'm not expecting it to break. But certainly if we get a high volume, big down day, anything could happen. And if you did break, then there's a high probability that you're going to come down into this 204.5, 205 neighborhood. Not all in one day, but that certainly brings that into the picture. If this 208 level, the exact number that I calculated is 207.79, if that breaks, then you've got to look down to this area here, okay? So that's my picture in the market. Hopefully that's helpful. Let's go over to the gold market. And earlier in the week, I mentioned that it's going to be a battle by the end of the month on where gold closes. It needs to close in my book, above 1174. And, could it close at 1172 and still be bullish? Yeah, I guess so. When I give you these numbers, okay, my numbers are calculations that I make based on historically the calculations that I do each and every year, each and every month, each and every week, each and every day. And, they're not necessarily the end-all be-all. In other words, it's either 1174 or bust. It's just really more of a guide. And, there's always a couple of point leeway in there, but anything more than a couple of points is off the table. So what that means is, let's say the month closes at 1165. I'm making up a number. Then no, that's bearish. And I don't consider that within the margin of error. And when I say margin of error, this is a good example, okay? Today in the S&P E-mini, the SPY or E-mini, either way you want to look at it, there was a trade here for my intraday traders, right? So anybody that's an intraday trader and you're looking at the 209.91 level, that produced a pretty good bounce. And you can see here that we did pierce through it, and the low was 209.77. So that's when I say the margin of error. It doesn't always cooperate to the point where the market's going to stop on the dime. My calculations have a margin of error, but they usually are pretty good. As you can see, they're normally pretty good. But they do pierce the levels, but they usually hold. And that's what I mean by margin of error. So hopefully that helps. But let's go back to gold. So if I go to the daily chart on gold, you can see that this red line I've got here, and this is a red line, which means it's very, very important. We're battling the red line, and my gut tells me that we're going to do the same tomorrow and the same on Monday, and we'll have to see what Monday brings, and we'll see whether it closes above or below that line. So that's where we are in gold. Right now, there's just no trade in gold because look where we are. We're right here, and it's really a critical position for the market to be in. So no trade in gold, but we have to wait until Monday to see where the month closes, and then we'll have a pretty good idea of what's next. Let's go to oil. Oil is still above our 59.30 level. That's important. And today the low is 59, what was it? 43. So 59.43 against 59.30. You can see that there's a battle brewing here at this 59.30 level. And even if I zoom into the hourly chart, what you'll see here is here's the top, here's the bottom. Now you're really making a bearish pattern. You're consolidating above this level. And what that means under normal conditions is that the more you consolidate above that level, the more likely it is that if you came into that level that it wouldn't hold. So I just want you to be aware that at this stage of the game, because we consolidated here for most of the day today, I'm going to suggest that even if tomorrow the oil market comes into the 59.30, I'm thinking that may break. I'm just not convinced one way or the other yet, and that's why I don't think there's a trade in oil right now. I've got to see a better pattern develop. If we get into this line on a straight shot and the market begins to firm up above that level, that's one thing. But if we go sideways above that level for more of tomorrow and Monday or something like that, then there's a higher probability that level would not hold. And what would happen if that level does not hold? Then you're going to have to target the next level, which is 57.50, and that's a pretty good way down from where we are now in the scheme of things in the oil market. So that's where we are. Again, we're in no man's land in between this range. So again, there's no trade in oil. So the market, some of the markets, namely gold, namely oil, they're just not giving us anything right now, but that'll clear up. Give it some time, give it a couple of days, and that'll clear up, and then it'll tell us what it wants to do. And that's what we're waiting on right now. We're waiting on the market to tell us what to do. If we break 59.30 and we begin to close hourly below that level, there's a high probability that we're going to go down and test 57.50. If we begin to reverse and go higher and we can break 61.65, then we're probably going to go to towards the top end of this channel. Whether we get there or not is suspect, but we'll see. Anyway, so that should wrap up oil. Let's go over to the bond market. So bonds were weak again. This is the TLT, tracks the bond market, right? So 20 and 30-year treasury bonds. And you're basically doing the same thing you're doing in oil that you're doing in the bonds, which is you're starting to consolidate over this line, which when that happens, just like oil, it gives less significance to this line the longer you hover over this line here. The longer you hover over this support level, the more likely it is that if you came down into it, it would not hold. That's the way it works. So watching the bonds, again, it's really the same thing. So now we have three markets where we have to wait for the market to tell us what to do. We have gold, the bonds, and oil. And believe me that these markets will clear up, and they're going to give us a trade here shortly, one way or the other. Whether it's on the downside or the upside, I don't really care. Either way, I just want the market to tell me what its next move is going to be. And right now, we're just in a waiting mode because it's not telling us yet, but it will. It always does. Okay, so let's go. In fact, let's just take a look at the yield chart while we're at it, because it does give a slightly different picture. And in fact, this is your double top in yields represents your double top in bonds. But this chart looks more clean than bonds, and what it does is it gives you a more definitive trend. And this is why I'm suggesting that I'm not sure that double bottom is going to hold, because if we're going to get a continuation of this move, right? We saw a low, a higher low, a higher low, and we have the A, B, C, and you can make a case that we have, another A, B, C here, and that was a corrective rally, and now we're going A, B, C. We'll see what happens, but you see that this market is stepping higher. So we have to be aware that basically your line in the sand is here, which is the same line in the sand on the bond market on the downside. So we'll have to see what happens over the next few days. But all these markets are going to clear up, and they're going to give us trades. Make no mistakes about it. Let's go over to the dollar. And here is the continuation contract on the dollar. And, like I said earlier in the week, I expected the dollar to pop up. I expected it to challenge this high here, and you actually closed above it. And what that normally means is when you close above, for example, when you close above this day here, above the high of this day, which you did, and now you're putting in, you've got 1, 2, and you're putting in some sideways consolidation after this big up move, that is the market telling you that it may want to move higher. We have to see how it plays out. If we come down here lower, then this pattern will be off the table. But right now, if you can go sideways for another 2, 3, 4 days, you're building momentum to get through the moving averages. Right now, the moving averages are keeping this market under wraps, the dollar under wraps. But if you can consolidate under the moving averages, then it's going to want to move higher. So we'll see how that plays out. However, now keep in mind, what I was telling you is that if I expect a market turn in around the Monday, Tuesday time frame in the stock market, that may coincide with a weaker dollar. It may coincide with lower yields. It may coincide with lower or higher gold prices. All those markets may converge at the same time, and that's why this time period is extremely important right now. Okay, so all these markets seem to be waiting for the turn that's on, let's say, Monday, Tuesday time frame, this weekend, Monday, Tuesday. That's the zone that we're waiting on. And once that hits and it clears up, it's going to give us a pretty good picture of what the next several weeks are going to bring. And that's what we're waiting on. But make no mistake about it, it will clear up. No two ways. Okay. All right, there is one stock I want to talk about tonight. It's in the portfolio, And for those of you that are not long Intel, I just want to point something out, because let me show you a retracement, okay? When you made this low and then you put in a pivot high, what you did is you came into the 618 retracement, pierced through it a little bit, but it held. And this is a daily chart, so when that held, that's a good sign that it most likely will hold as long as you can maintain above it. Now you're below the moving averages, which is bearish, but you're putting in one of those sideways consolidation patterns to hopefully build momentum to go through the moving averages and trade higher. So what I'm suggesting here is that this looks very similar to what we just talked about on the dollar, and if you can go sideways for another couple of days, even a little bit lower, sideways to lower, there's nothing that says this market can't trade higher or Intel can't trade higher. So that just gives you a little lesson in how I do my retracements, and you can I can even eyeball this, right, and see that this was about a 618 retrace. 50% would have been right in here, and it just, you can see that in these markets it happens over and over again. Let's take a look at a longer term picture of Intel and see where we are. So actually, this looks pretty bearish. I haven't even looked at this in a while on the weekly chart. You've got a head and shoulders developing here, so that's interesting. So I've got to keep my eye on that. But if you do the same type of retracement we just did from these lows here on the weekly chart, okay, if I can get the Fibonacci tool to take hold, there we go. Okay, so you can see that what you did here is you came into a 382 retrace, and then the market traded higher, and now you came back down to retest it. So the fact that this head and shoulders pattern is developing is kind of ticking me off a little bit, because I'm surprised I didn't see it. I just haven't looked at a weekly chart of Intel. Intel's one of those stocks, when I put, by the way, so stocks in the portfolio, normally, as you can see, the majority of stocks in there are quality stuff, and they're stuff you don't necessarily want to babysit. You want to let them go as long as the market is bullish. And I've been saying that the market's going to be bullish up until it's not, and I'll tell you when it's not, and we're not there yet. Even though we've had a down week and the market's been very choppy all year long, we're still, we still have these rallies, and one of these rallies has the potential to break through to new all-time highs, and that may or may not happen this next time. But that's why you want to let these stocks go until the rally is coming to an end. When the rally's coming to an end, you're going to see the portfolio change complexity dramatically, okay? And you're going to see it happen all within a few days period of time. But this head and shoulders pattern right here, you can see that there's a possibility that this doesn't hold, right? So what does it look like? So you have, and those of you that paid attention to the Kihu head and shoulders from last night, it's really the same thing. Left shoulder, head, right shoulder. So where would this take us? So the high is we'll call it $38 for a rounding error, and the neckline is putting it at 30. So this could portend a move down to the $22 area down here, and that would be relatively ugly. And let's just see the way the market works. Let's just see what that does. I should have left this in there, but I want to see where that takes us in the fibs. Okay, yeah, well, even past the 75 retrace. So we'll see if that plays out. But if it does or if it doesn't, we'll see what happens. But I don't like that, so that's getting me a little concerned. Anyway, okay, so you saw a real-time shocker for me, a real-time analysis. I took a look at the weekly, which I probably haven't looked at in a few weeks, and that's why I didn't see this head and shoulder. Anyway, all in all, hopefully this has been helpful, folks. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis. We'll see you tomorrow.